radio for a really great future. We're talking real money.
What do we want? More money. When do we want it? Right now. With what do we want it? No risk. Oh, sorry. You got to give up something. And it's true. We crave higher returns. We think that there is some trick to getting higher income from our investment portfolio. And another problem is we tend to focus on the income side. We forget that growth can be income. And sometimes when we focus on income, we get led into investments that aren't good for us. Hi, everybody. I'm Don McDonald. Along with Tom Cock, this is Talking Real Money, the podcast. Glad you could join us. You already know what it is because you clicked on our name on the podcast service. I don't even know why we have to introduce it. You already know what you're listening to, don't you? I mean, you don't just accidentally hit a podcast, do you? I don't think you can. Anyway, thanks for joining us for the program. Today, we're going to talk about magical, high-yielding investments, or some people would like you to believe that's what they are.
It's a fascinating topic. I love the way you open this program that, we want something for nothing. We want a lot of money without risk. I want to eat chocolate cake every day without gaining weight. None of those things are going to happen, sadly. And this comes from a recent article from Larry Swedroe, whose work I greatly respect. He has a Substack that I read almost every day. I think some of it's, for many of us, too far in the weeds. You really got to be. Of course, it's too far in the weeds. He's a very intellectual fellow, which is great. But he writes in a recent article, "Are high-yield bond funds, also called junk bonds, worth the risk?" And then he looks at a new study. He always has recent studies that came out. This one's called "Characteristics of High-Yield Bond Funds." It was just published last fall, where they analyzed the performance of high-yield bond mutual funds from 1985 through August 2023, comparing their performance against investment-grade bonds. Why don't you explain the difference between an investment-grade bond and a high-yield fund, or bond, pardon me?
Well, an investment-grade bond is one that is considered to be of high quality. It means that banks can use it and still be considered responsible in their investment portfolios. And it, generally speaking, is anything that is above BBB. So an A-rated bond, a AA-rated bond, a AAA-rated bond, a government bond, high-quality corporate bonds, those are investment-grade bonds. Below BBB, they are called high-yield bonds, if you like the industry's vernacular, or the reality is junk bonds. They're not. So they can they can default a lot more easily.
Yeah, so they look at comparing the bond funds against investment-grade bonds, the high-yield bond index, world government bonds, these are issued by governments, and global stocks. You're going to see here in a moment that they have a lot more to compare to stocks than they do bonds. And remembering, stocks are investments in companies, right? You're entitled to the earnings.
Corporate bonds kind of are, but you're buying the company with stocks. With a bond, you're buying a debt obligation.
Exactly. So they're very different type of security. So it included 324 funds, $238 billion in assets as of August 2023. So, and since we went through these, I mean, the reasons that companies issued that they end up being lower rated is the company may be really leveraged, right? They may be facing financial difficulties, or they're unproven. People don't really know them, right? There's a variety of reasons that they're in junk status.
I mean, a pretty good example of a bond that was junk were the bonds issued by Saks,
which have been in the news recently, as you may know.
Because they're bankrupt.
Exactly. So, and I don't know, I always forget the bankruptcy. Where does debt end up on that whole, who gets paid?
It depends on the debt. It depends on the type of debt, where it falls in order. Their debt rating, by the way, was CCC.
Yeah, so that would be well into the high yield
well into
area.
The junk bond area.
Pretty bad.
And a lot. What's going to happen with those kinds of bonds is they end up being restructured, renegotiated. A lot of the bondholders will lose money to get a deal where they get some of their money back rather than none of it. If they go to Chapter 7, which is liquidation, then they only get pennies on the dollar from whatever the assets are worth. So in a reorganization, that basically means restructuring the debt.
Yeah, not good. By the way, these funds, This is fascinating to me. Also, the funds, according to Larry, according to the study, average expense ratio of 1.12, and they turn over their holdings about 70% annually. So these are high turnover, very high expense for fixed income.
So basically what that says is if they had 100 bonds in the portfolio, in a given year, 7 of those bonds leave the or 70 leave and are replaced by other bonds.
Fascinating. High-yield bond funds generated average monthly returns of 0.58, outperforming investment-grade funds 0.49 and world government bonds at 0.48. This is exactly what we would expect, by the way.
Yeah, because they're riskier.
Yeah, we'll get to that right now.
You should get higher returns in markets that are strong, in markets where you don't worry about these companies going out of business immediately, eminently. But should an economy go into a recession, corporations will suddenly start struggling. More of them on that lower end of that rating scale are going to get in financial trouble. And when they do, there's going to be a lot of bankruptcies and a lot of bonds being restructured or, in some cases, written off entirely.
Yeah, we'll see what kind of shopping it takes for your aforementioned retailer to come back. These funds have a fair amount of volatility. That's a measure of, we use standard deviation for. There's others, of course. But the standard deviation is 2.19. That compares to investment grade funds, bonds rather, 1.2, and riskier equities at 4.4. So that's what we mentioned at the beginning. They look more like stocks in terms of the volatility, the ups and the downs. And so the risk adjusted situation here is that's the one you always want to know about investing, right? Because people could say, look, I was just in the Mag 7 for the last 10 years. I made basically 1,000%. How much risk did you take to make that 1,000%? A lot of risk. And so we're always careful about that. Sharpe ratio 0.15. I don't want to get it too far into that. But
when we start getting, if people's eyes start rolling when you start mentioning standard deviations and Sharpe ratios.
Yeah, not of course the Sortino ratio too, but they also found that this is another very important thing, because you would think when you're buying individual bonds, as these bond fund managers are, that they would be able to add value. Not the case. The takeaway for investors, according to Larry, passive beats active, equity-like behavior, as we mentioned. Fee drag is tremendous. And then something you just mentioned, Don, that I think is very important, high-yield bonds are particularly vulnerable to economic conditions. Let me give you an example, because I looked this up. The Vanguard high-yield bond index fund, which is, if you had to own high-yield, that's probably where I would go.
Best, yeah.
VWEHX. So tell me if this sounds very bond-like. In 2008, this fund lost 21%. Now, government bonds actually made money in 2008 because, again, the quality of that loan, if you will, much higher in a government bond than a speculative corporate bond. So this is, again, when we're looking at the world, people write us a lot of times and say, wait, I could be in this high-yield bond fund and make a whole lot more money. And we say something to pay attention to is the risk you're taking. Number two, and this is from my friend Reuben Miller, who used to be at Dimensional Funds and writes regularly, and I think he's absolutely right. When you're looking at your investment, he says yield is for farmers. Many people look at the yield of these and say, wait, I'm going to make a whole lot more money, and you're not paying attention to the potential downside. Stocks are for gains, bonds are for holds, and we should not be comparing stock and bond returns, which I see as well, especially last year. Again, intermediate term bonds made about 7, stocks up depending on your portfolio, but should be in the 20s somewhere with U.S. and international. So this is a great paper. I think Larry does really good work, but it's food for thought for anybody who oftentimes get caught up in this comparison. This bond fund pays more. Shouldn't I just put my money there? That's just something that could lead to some really bad times when you don't want the bad times. Because remember, 2008 stocks got hammered too, and you don't really want to be in a bond fund that's getting beat up as well.
Yeah, and when we talk about Vanguard, remember, we're talking about the best of the bunch. There are junk bond funds that yield double-digit income. Vanguard on their junk bond, high yield bond fund, their yield right now is a little over 6.
Yeah.
Which compares with BND's of about 4.
Yeah, that should be expected, right?
Right, but Vanguard's is a higher. There are varying degrees of junk funds, of junky funds. Vanguard's is mostly double B, so it's just below investment grade. A lot of them are non-rated or Bs or even triple Cs, like Saks debt. And when you get into that kind of debt, you, of course, receive a higher yield. Why are you receiving a higher yield? This is the question you can easily answer every time someone offers you a higher yield. The only reason you are offered a higher yield is because you will be, whether you know what it is or not, taking more risk. It is such a simple equation. Higher returns mean you're somewhere along the way taking higher risk. You may not realize it, but you are.
And the thing about that, thank you, that's well put, but the thing to remember about that is it could come at the very worst of times. As I just mentioned, 2008 stocks got hammered and high yield bonds got beat up as well. What you're really looking for, and there's no direct tie between stock and bond performance, but you really want to have assets that are going to sort of hold their own, right? Be the ballast when stocks get beat up again, which could come at any time. So that's another reason not to own high yield debt. Another one is just frankly the thing you mentioned a moment ago is the default risk of anything. And if you go out and you buy really risky high yield, you could face massive defaults.
Well, and here's the thing. Take risk that you understand better. If you're going to be taking risk that's equity-like, why not make it in equities, where we know, at least in the past, the reward has been pretty substantial for the level of risk you take. The rewards for junk bonds, given that they are equity-like returns, have not been as high as equities over time. So why not just have equities for the risky stuff and have high-quality bonds for the ballast, for the safe stuff?
You have been so kind to write us so many questions here over the last few weeks that we want to get to them. So from Bloomington, Indiana, Catherine writes us, "Hello, I love listening to your podcast and have learned a lot. I'm a 75-year-old widow who has recently moved her $150,000 HSA, health savings account, from high-cost WEX to Fidelity, considering how to invest the money. I pull $7,500 to $10,000 for a Medicare premium reimbursement, medicines, dental, and eyewear. The money's currently in Fidelity's money market account. I'm wondering about putting $50,000 in a 5-year CD ladder and putting $100,000 in a stock index fund, or I could leave $50,000 in the money market and invest the rest. What do you suggest? Would the Fidelity Index Fund be a good way to go?" In other words, taking some risk with your HSA where you're taking out, let's just round it to $10,000 a year. So that's, to me, the issue here. You don't want to be in stocks if they go down and you need the money.
Right. You've got to be very, 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 that's high yield savings, really.
For all of it. I don't think there's any stock exposure.
Or a CD, no stock exposure. Zero.
Okay. I'm with you there because, and by the way, if you have an additional medical emergency, then it would require more money to come out of it. So I think that's good. From Seattle, Lawrence writes us, "My grandson wants to start a Roth IRA. He has 41 years before it would be available. What is a good fund for him to start investing in?" That's a long time horizon. 41 years until they need the money. A fund.
Didn't we do this in the last podcast?
I answer the questions as the tree falls, and I peel them off the outside.
And what did I say? Didn't I say like AVG?
So then I think this time you should flip over and do the dimensional DFAW.
But DFAW does not have the higher value, small cap tilt of AVGV.
So that means dimensional now is to come up with a new product.
Yeah,
and
which
also
would be
matches up with
DFAV.
Whatever. AVGV would be a good start. AVGE if you want to have less.
It's a little more conservative.
Yeah.
DFAW, it's a little more conservative.
Any of those
than
three
AVGV.
would be just fine for your grandson. And I just love people that give these head starts to young people because you're not going to be there to see the joy when they have all that money tax-free, but there will be joy. I mean, that will be a happy day when they wake up.
There will be, I don't know if it'll be joy, but there will be comfort.
Rejoicing?
There will be much rejoicing.
Much rejoicing.
And there was much rejoicing.
From Atlanta, Georgia, Joe writes us, love your show. Learned a lot about finances from you, especially all the great things about annuities, said tongue-in-cheek. My question, I'm 55 and make, Joe, we do the funny stuff, and make more than allowed to contribute directly to a Roth IRA.
By the way, that's debatable. That's debatable.
Whether it was funny or not, or whether we're
we
funny.
Do the funny stuff.
Okay, well, that's true, too. Remember, we had the one guy who said, you got to quit the jokes. The jokes aren't funny. Knock it off. At least that was only one that I read, but maybe more. I contributed $8,000 of after-tax money to a traditional IRA and did not make any other money in the traditional IRA at the time. Vanguard, he says, required me to wait a week before I could do the backdoor conversion. This is where you put money into an IRA and then move it from the IRA to the Roth, tax-free. During that week, he says, the IRA increased in value by $100 to $8,100.
Oh, you had a taxable event.
My wife and I have been researching and discussing whether I owed the 6% excise on the $100 that the IRA increased in value, but have not found anything conclusive. So I think what you're going to want to do, I'm sorry to interrupt you here, Don, but I did ask a few advisors about this. Yeah. And they said just move the whole 81 over to the Roth and pay the tax on the 100.
Yeah. That's what
because otherwise you're going to leave the 100 behind. It's going to get messy. Then next year when you do the conversion,
just pay the tax on the 100. You made $100 you didn't think you were going to have.
Exactly.
Who cares if you got a tax?
Yeah, exactly. The backdoor Roth really is a Roth conversion. That's really what you're doing. You're taking pre-tax money, you're moving it into the Roth, and in this case, you take the extra 100 and you do it. So, all right, here's the final question.
Again, I hope they're aware of the pro rata rule, though.
That's what I was saying. So you're going to pay something on that 100.
Yeah.
Yeah.
But I mean, there may be other monies you may have to move to.
No, they said there is no other money. This is the only one.
Oh, so they said there was. I missed that part. Mm-hmm.
Yeah. Okay.
I was hitting my cough switch, not to cough.
From Beaver Dam, Wisconsin, Carl writes us, I never hear you mention the Vanguard Star Fund, VGSTX.
Nope, not going to.
Been around a long time and is a fund composed of other Vanguard funds and diversified. Look forward to your podcast all the time. Thanks. The Vanguard Star VGSTX, which is an actively managed.
That's why we won't mention it.
Vanguard fund.
I used to mention it a long time ago.
It's been around a long time.
Because it's been around a long time. It's more conservative than a balanced fund. It has more fixed income. It's very, 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 very well diversified. However, and it's very well diversified. By the way, it even has a value tilt. It does.
So what is the stock to bond ratio for starters?
The stock to bond ratio is, no, I take that back. It is a 60-40. I thought it was lower than that.
And what is the expense ratio?
It's low. It's 30 basis points.
Okay, so for an actively managed fund, that's on the inexpensive side, no question.
But it's all made up of Vanguard active funds.
And is it U.S. and international, or is it just U.S.?
Yes, U.S. and international.
Okay, so it has a global mix.
For an actively managed fund, it's about as good as you can get. It really is for active management. It has performed well. I got to give it credit. For a relatively conservative fund, its 15-year return is 8.5%. And it's a balanced fund, basically, so that's right in line.
So I don't know that there's other than the Vanguard Balanced Index, which is just U.S. stocks, that I could come up with a passive or index-style fund to compare it to. For example, if you wanted to come up with a 60-40 global, you could take one of the global equity ETFs that we talk about, and put 60% in that and put 40% in the BND. So then you get the mix. You're going to get more value. You're going to get more small, or if you really want to get more value in small, AVGV, for example. So that would be my better option rather than just this one fund option at Vanguard for the aforementioned reason that it does have active management as part of it.
Yeah. Now, the Vanguard Balanced Index Fund, which is the best comparison, actually, see, even though the Star Fund did pretty well, part of the it didn't do as well as the Vanguard Balanced Index, but this is not a fair comparison.
No, they're very different.
Because they're very different in that the Vanguard Balanced Index is not global.
Correct. It's only U.S. stocks.
Right.
Yeah.
So the reason the Star Fund has underperformed a bit is in large part because of its international exposure, which means in a better international market, Star could wallop the balanced index. But the reason we don't suggest it is the slightly higher expense ratio. I mean, bear in mind, the balanced index is 7 basis points, 7 100ths of 1%.
That's
versus
1
30.
quarter. Yeah, that's far cheaper. So, yeah, and again, that would be our take. Nothing wrong, I guess we could say, with this
I'm
fund.
saying
We wouldn't pick it.
If I was to, somebody said you cannot buy an index fund. You need to create a really diversified portfolio, and you cannot use index funds. This would probably be one of my first choices. I think that's fair.
It has a track record to suggest that the management is good.
Very good.
Yeah, been a long time. So
some of the better management in the industry.
Yeah, for sure. So those are the questions. I have a question for you. What in the world are you going to be talking about at RetireMeet 2026?
I'm going to be talking about the fact. I love history. I am a history fiend. I read history. I watch history.
You're part of history.
Yeah,
you are
I'm
history,
even
as we like to say.
No,
not what I was saying.
So what I'm doing is taking my 2024 presentation and updating it and changing it a little bit and changing the name to The Evolution of Retirement Investing.
Ooh. Anything new from last year's presentation?
No, I didn't do this last year. I did a different presentation last year.
This is the one with like the railroads and all the other stuff.
Yeah,
I love that one. Yeah, of course, I'm a history guy, so I'm going to love that.
So this is the history one. I really enjoyed doing it. I thought it made some great points about, again, why we have it so much better in so many ways than previous generations. We've got to quit being whiny babies. We really have it better than our parents and grandparents did.
Present company
great-grandparents, because, I mean, my great-grandfather was in Andersonville camp in Georgia. So
can't get
I have it a
worse.
whole lot better than him.
No, yeah, exactly. You're not stuck in a hole somewhere in Georgia with 8,000 of your favorite people with no food. And
more like 30,000.
Whatever it was, yeah. So anyway, okay. So why am I asking Don about that, shockingly?
I know you're doing income.
Yes, I am doing income. I've been kicking around a few ideas to make it a little different.
No, you've been doing income for the last
I know, but I'm trying to
years.
I'm waiting for my own to kick in. I'm going to make it a little different. But anyway, so we're both going to be there on Saturday, March 7th in beautiful Bellevue. You're welcome to join us if you can. If you can't, and we do have people flying. We have somebody coming in from the East Coast. We've got somebody coming in from Arizona. I've already talked to somebody from California. So we'd love to see you. And it's sunny and, of course, very warm in Seattle in March. That's a guaranteed.
Yeah. The palm trees are swaying in the breeze.
Exactly. Indoors. So join. And Paul Merriman will be there. And
you
Joe
can pick oranges off the trees on the Maidenbauer patio.
Exactly. Christine Benz from Morningstar, all on the stage that day in the Maidenbauer Center. We'd love to see you. By the way, if it doesn't work for your travel schedule or you're just so tired of being sunny and hot all the time, so you don't want to come to Seattle, you can do this online. That's right. We now do this virtually. Either way, you go to RetireMeet.
We virtually do it.
We virtually do it anyway. You can go to RetireMeet at meet.com and register right now. And by the way, if you're coming in person, hurry up because, frankly, the tickets have been going very fast for the in-person event, as they always sell out, and that will sell out soon. So if you want to see us, get on it. If you want to see us virtually, not as critical, but we charge a small fee. By the way, we don't keep any of that money. We give it away to 2 groups that are committed to financial literacy. So Saturday, March 7th, RetireMeet 2026. I don't want to say this is the last one, but we're inching closer to this being the last one. It's just like...
Because we're getting old.
Hold us up on stage there, wander up. Yeah. Weekend at Donnie's, Bernie's, sorry. Sorry.
Wait a minute, what was your name again, sir?
Exactly. Yeah. Well, doesn't really matter at this point. So,
Who
join
are
us.
you?
We'd love to.
Where
to
am
see
I?
You. That doesn't really matter.
How did I
either.
get here?
Not in the existential manner, sir.
Yeah.
So we'd love to see you. So join us. RetireMeet 2026. Yeah, it's coming up fast.
All right. And if you want to send us questions, go to talkingrealmoney.com, click the contact form. It's easy. Just do it. And we love helping you out. So go to talkingrealmoney.com. That's talkingrealmoney.com. And we call it talkingrealmoney.com because here on the podcast, we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.